Trading around the $3.88 mark with a market capitalization hovering near $2.3 billion, Keel Infrastructure Corp., NASDAQ, KEEL, represents one of the most fascinating psychological mispricings across North American digital infrastructure. If you pull up financial media headlines or skim retail-heavy forums today, you'll see the ticker frequently shackled to an outdated narrative, dismissed as a legacy crypto mining proxy vulnerable to every single swing in the digital asset market. Wall Street consensus and the public scrolling through automated trading apps look at the trailing net profit margins and see a volatile, capital-intensive asset player struggling with near-term bottom-line compression. But this superficial framing completely misses the underlying structural reality and the physical bottleneck that dictates modern computing economics: power. We are living through a historic infrastructure crunch, where the global race for artificial intelligence and high-performance computing, HPC, has run straight into a brick wall of grid capacity, transformer shortages, and environmental regulations. While retail investors obsess over daily price action and short-term volatility on platforms like Robinhood or Webull, institutional heavyweights are looking past the noise to focus on a massive, unappreciated asset base, secured power rights, and grid interconnections. Keel Infrastructure doesn't just own real estate, it sits on a sprawling 2.2 gigawatt pipeline of high-demand power markets spanning Pennsylvania, Washington, and Quebec. In an era where hyperscalers are starved for megawatts to fuel next-generation AI clusters, possessing brownfield and greenfield sites with pre-established grid interconnections is the equivalent of holding the oil fields of the 21st century. The market is currently pricing Keel as a cyclical commodity miner while completely ignoring its deliberate, high-stakes transformation into a specialized high-performance computing and AI infrastructure provider. Retail traders panic selling during routine drawdowns fail to realize that the physical constraints of the electrical grid cannot be solved by software updates or venture capital funding rounds. It takes years to secure transformer allocations, substation approvals, and multi-megawatt power purchase agreements. By securing these critical power nodes ahead of the broader market surge, Keel has built a defensive moat that cannot be easily replicated. Understanding this asset transformation requires stripping away the legacy ticker baggage and analyzing the underlying physics of electrical distribution and data center architecture. Market dynamics and institutional positioning. Beneath the surface of Keel Infrastructure's daily trading volume, which frequently sees tens of millions of shares changing hands, a classic institutional accumulation pattern is playing out. Macro jitters, fluctuating cryptocurrency sentiment, and broader tech sector consolidation have created recurring pullbacks, giving sophisticated players ample opportunity to absorb shares from impatient retail hands. When the stock experiences sharp, sentiment-driven dips, automated algorithms and short-term swing traders trigger stop losses, creating a cascading flush of liquidity. Institutional desks step directly into these liquidity voids, steadily building long-term positions while the retail crowd gets shaken out by short-term noise. This dynamic is further reinforced by corporate finance maneuvers designed to optimize the capital structure without inflicting structural pain on existing equity holders. For instance, the company's recent strategic capital raising efforts, including upsized convertible notes offerings designed to minimize immediate equity dilution, demonstrate a management team actively managing its cost of capital to fund long-term infrastructure deployment. Institutional investors recognize that transitioning a multi-gigawatt power and data portfolio requires heavy upfront capital expenditure, but they are pricing in the long-term visibility of cash flows that come once these facilities are locked into multi-year triple-net lease agreements with high credit-worthy HPC and AI tenants. Wall Street analysts maintain a predominantly bullish stance on the name, with consensus price targets pointing towards substantial upside from current levels as the market slowly wakes up to the asset value of their real estate and power pipeline. Yet, retail participation remains heavily fragmented, caught between skepticism over historical earnings volatility and excitement over the artificial intelligence infrastructure boom. Before we dive deeper into the operational mechanics and historical evolution of the company, let's look at the broader picture. Where do you currently stand on infrastructure plays like this? Are you actively accumulating shares during these macro-driven pullbacks, or are you waiting for definitive proof of sustained profitability before taking a position? Drop your thoughts in the comments below. Business model and historical context. To understand where Keel Infrastructure is heading, we have to look closely at where it originated and how its operating model has radically evolved. Originally recognized under its legacy identity as Bitfarms, one of the pioneering cryptocurrency mining enterprises, the company built its foundational expertise on mastering the most demanding operational challenges in the digital infrastructure space: extreme power density, thermal management at scale, and 24/7 electrical reliability. For years, the market boxed the company into a narrow, highly cyclical box, treating its valuation as a direct derivative of blockchain valuations and hash rate economics. However, looking at Keel through the lens of a legacy crypto-only miner is a fundamental analytical error today. The core operational segments of the business have undergone a profound structural shift. While the company still maintains substantial assets dedicated to validating blockchain transactions and hosting third-party hardware, the strategic North Star has pivoted decisively towards building out next-generation data centers tailored explicitly for high-performance computing and artificial intelligence workloads. This pivot is not merely a branding exercise, it represents a complete realignment of corporate assets towards high-margin, long-duration enterprise contracts. The company's footprint across key locations such as Moses Lake, Panther Creek, Sharon, Sherbrooke, and Scrubgrass showcases a geographically diversified portfolio strategically positioned near low-cost, reliable power sources. In the legacy era, these sites were valued entirely on how many terahashes per second they could generate per kilowatt hour. Today, those exact same megawatt capacities represent prime real estate for liquid-cooled server racks running complex large language models and neural networks. Furthermore, the company retains specialized operational arms, including commercial and industrial electrical service capabilities in Quebec, giving it an in-house engineering advantage that drastically reduces deployment times and maintenance overhead compared to competitors who rely entirely on third-party contractors. By systematically shifting its revenue mix away from volatile spot market computational output towards predictable, long-term co-location and infrastructure leases, Keel is effectively bridging the gap between heavy industrial power generation and modern enterprise cloud architecture. This evolution transforms the company from a cyclical commodity player into an indispensable structural landlord for the digital economy. Future outlook, catalysts, and risks. Looking ahead over the next 3 to 5 years, Keel Infrastructure's growth trajectory is tied directly to the multi-year capital expenditure cycles of mega-cap technology spenders and enterprise AI developers. As artificial intelligence models scale exponentially in parameter size and computational complexity, the demand for specialized data center space equipped with advanced cooling systems and massive electrical feeds has completely outstripped supply. Keel's 2.2 gigawatt power pipeline positions the company as a prime technological gatekeeper. Because obtaining new grid interconnections in major power markets can take anywhere from 3 to 7 years due to bureaucratic backlogs and transmission line constraints, companies that already hold energized sites possess an irreplaceable competitive advantage. The primary catalysts for the stock will center around the successful execution and announcement of high-profile HPC and AI leasing agreements across its Pennsylvania, Washington, and Canadian campuses. Every time the company converts a megawatt of legacy crypto capacity into high-yielding artificial intelligence infrastructure, it fundamentally re-rates its revenue multiple in the eyes of institutional investors. Additionally, potential regulatory changes, localized energy market dynamics, and partnerships with major cloud service providers or sovereign AI initiatives serve as powerful near-term catalysts capable of rapidly compressing the valuation discount currently plaguing the stock. However, prudent risk management requires acknowledging the headwinds and operational hurdles that lie ahead. The path to transforming a legacy mining fleet into a Tier 1 AI infrastructure provider is capital-intensive and fraught with execution risk. The company must successfully navigate ongoing capital requirements, manage